There are a lot of things said about Social Security, and it can all get pretty confusing. And are all these things said fact, or are they fiction? And today we're going to go through 5 common things said about Social Security and discuss just that, fact or fiction. Because the more that you know, the more that you can help increase your future retirement income.
Welcome to the Your Life, Your Money podcast with Scott Searins, teaching you how to thrive in life, wealth, and retirement.
Welcome to another episode of the Retirement Show, all about your life, your money, and well, today we're going to talk about your Social Security. We're going to clear some things up. We're going to go through Social Security fact or Social Security fiction. Fact or fiction when it comes to your Social Security, your retirement income is really important, and understanding Social Security is a big part of that. Now, I'm your host, Scott Searins. My goal is to help you thrive in life, wealth, and retirement. And our goal is to help you hopefully do just that today in regards to Social Security. Now, before we dive into retirement income, I first thought I'd share with you this article in regards to retirement expenses. So take a look at this if you're watching on YouTube. If not, I'm going to explain it to you as well. So I've got an article here that I'll link to in the show notes from Go Banking Rates. It said retirement planning, how much the average 65-year-old retiree spends monthly. So let's scroll down here. Let's take a look to see what the article says. Here we go, average retirement spending. And I want to go over this, but don't take any of this, in regards to your specific situation. And I'm going to explain that in a little bit. We do have some takeaways from the article that I thought were important to share. But first off, as you're listening to some of these numbers, some of you might think, well, how could they survive off of that? That's not enough. And then some of you might think, that's a ton of money. And so everyone's different, but let's just kind of read here, and then I'll kind of give you my take on the article. And then, of course, we'll dive into Social Security. So here we go. According to the Bureau of Labor Statistics, the average income of someone 65 and older in the year 2021 was $55,335. The average expenses were $52,141, or $4,345 a month. So here we go, 65 and older. The average expenses, average amount that they needed to live their lifestyle, $4,345 a month. And then it also found that the expenses for younger retirees were greater than those for older retirees. So those that are age 65 to 74, the average expenses were $4,870 a month. And for those 75 years and older, the average expenses were $3,813 a month. Okay, what's the takeaway from this article? Well, a few things is, first off, a good takeaway is, just like it talked about, is that people are spending more in those younger years, those go-go years of retirement, than in the later years. And so that was evident from what it said, right? 65 to 74, they're spending $4,870 a month. 75 and older, gosh, that dropped by $1,000 a month, $3,813 a month. So a little bit over $1,000. So one good takeaway is that in regards to your expenses, do you also plan, or have you built a plan around the fact that you might spend more in your 60s and early 70s than what you might in your 80s? The other takeaway is this: everyone's different. So if you're building your plan, please, please, please do not read articles like this and build your plan around it. Don't read articles like this and go, oh, well, the average person needs $4,300 a month. Because as I mentioned, some of you are probably listening and watching this going, yeah, that's not enough. I've actually done it for my lifestyle. That's not enough. And then others of you are going, hey, that's a lot of money, and that would be way more than what I need. Everybody's different. And some of you, it might come out pretty close to that. But here's the thing. Don't read, look at articles like this and think that, oh, well, because the article said that it's the average, that's what I'm going to build my plan around. Because if you did that, you could have a plan that it could be way, way off when it comes to your retirement. So the takeaway is, don't take articles like this and use these numbers, but really understand what your cash flow will be in retirement. Have a great understanding of how much is it that you need each and every month to live your lifestyle. That would be expenses, groceries, you name it, whatever it might be. How much do you need to live and maintain your lifestyle? And like the article said, maybe what you're looking to do is spend more in those go-go years versus the slow-go years. And we've talked about that on the show before too. And so are you taking, and what I like to call it is front-loading the plan. And that's what we help a lot of clients with, is front-loading the plan. How can we take and front-load the money that you're going to spend, knowing that there'll still be enough in the back end side of things for maintaining your lifestyle, but again, in those slower going years where you might not need as much. So understanding your expenses is a huge portion of planning for your retirement, just as important as understanding your income. And Social Security plays a huge part of your income for your future. And so today I wanted to, again, clear up some of the statements that are out there and go through Social Security and just talk about 5 different statements and say, hey, are these statements fact about Social Security? Are these actual facts, or is this just fiction? Is this something that people are saying and they're saying it and they're just kind of saying it out of the blue, right? And you're like, oh, well, I guess maybe I should pay attention to that because my friend Bob said it. And Bob's a pretty smart guy, so I should listen to Bob. But maybe it's just fiction. Maybe that's just what's on Bob's mind, and Bob's not necessarily the guy who's helping you plan for your retirement. And so understanding Social Security is a huge part. Now, if you're not yet taking Social Security and you want some help or a guide, again, today's episode is going to be helpful towards that. But we do have a full guide on understanding Social Security that you might find helpful. You can get it at lifemoneyshow.com/Social Security. Again, lifemoneyshow.com/Social Security. That guide might be able to help you improve and optimize your benefits by hundreds or thousands of dollars, which can mean a lot when we, again, go back to the expenses that we have coming in. Social Security is going to play a huge role in paying off those expenses. So here we go. Social Security, we've got 5 statements that we're going to go through, talk about if those statements are fact or fiction. And topping off the list with number 1, Social Security is taxable. That is a fact, depending on how much you have coming in. All right, so up to 50% or up to 85% of your Social Security can potentially be taxable. So that's why I said it's a fact, depending on how much you have coming in. And you see, up to 50 or 85% adds into your taxable income. Now, one thing that I think is kind of this misconception out there is that when people hear their Social Security is taxable and up to 50% or 85% is taxable, then they're thinking, oh my gosh, they're going to take 50% of my Social Security, or they're going to take 85% of my Social Security. Nope. Let's clear things up. They are not doing that. It adds into your taxable income to then get taxed. So it doesn't mean they're going to take 50%. 50% adds into your taxable income, and then a portion of that's getting taxed just like all of your other income. So let's just kind of walk through things so you know how much you would make, and then is your Social Security getting taxed or not? Let's just say for a single making more than $25,000 of modified adjusted gross income, then 50% of your Social Security is taxable. Now, if that same single makes more than $34,000 or has more than $34,000 of modified adjusted gross income, now 85% of your Social Security adds into your taxable income. Married filing jointly, and again, all of these are for 2023. Here we go. If your modified adjusted gross income is more than $32,000, 50% of your Social Security becomes taxable. And then $44,000 and over of modified adjusted gross income, 85% of your Social Security now adds into your taxable income. Okay, so let's walk through an example. Let's say you're single and you've got $36,000 a year of Social Security. And let's just say your modified adjusted gross income is $30,000. Well, you're over the first tier, right? So you're above the $25,000 level, but you're below the $34,000 level. So what does that mean? Well, that means 50% of your Social Security adds into your taxable income. So if you had $36,000 coming in, that means $18,000 of that Social Security adds in to your taxable income. That's how it works. That's the IRS rules. That's how your Social Security can, yes, potentially become taxable, and how much of it would potentially become taxable. Now, just to kind of talk about a few things around this, a lot of times people just say, well, I'm just going to go ahead and take my Social Security, and then they're working as well. Well, now you're just putting more of your Social Security in a position where it would get taxed. Now, the other thing is that maybe you don't necessarily need it. Well, then do you want to potentially delay taking your Social Security because then it's growing and it's not creating more taxes or throwing you up potentially into a higher tax bracket as you're waiting to take it? So a lot of times, people just get very emotional about taking Social Security. I want to get everything back that I've paid in, which is fine. There's nothing wrong with that. But understanding all of the aspects around Social Security can also be helpful, because if you're just taking it, but you don't necessarily need it, maybe there's a better strategy for you in your situation. Are you now just making more of your Social Security actually add into your taxable income? You're just making your whole tax picture higher as well. And you might be thinking, well, wait a second, I'm in retirement. I don't necessarily have a lot of taxable income. Well, it depends. You don't know for sure. Well, you do know, and it's all based on what you have coming in. So let's just talk about a few things that are adding into your taxable income to help you determine then whether or not your Social Security would get taxed. So for instance, you have $30,000 of Social Security coming in. Well, $15,000 of that doesn't necessarily mean yet that it's going to get added into your taxable income or not. But when they're figuring out your modified adjusted gross income, $15,000 is going towards that number. What else? Well, maybe you've got rental income coming in. Maybe you've got pension income coming in. How about your dividends, interest? Maybe you've got money sitting in a high interest savings account right now at the bank. Guess what? All of that adds in towards your modified adjusted gross income. So dividends, interest, wages. Maybe you're still working. That all adds up. And then the big one that a lot of people were hoping, well, wait a second, this is my retirement. That shouldn't count towards my Social Security getting taxed. But guess what? It does, would be your IRA withdrawals. That's right. Money that you're taking out of your 401ks or your IRAs. And that also adds into your modified adjusted gross income. So in your 70s, when you have to start taking those required minimum distributions, it all plays a part. So there we go. Fact or fiction on Social Security. The first statement, is your Social Security taxable? Yes, depending on how much you make, it could potentially add into your taxable income and get taxed. All right, the second statement that I hear a lot is that you should start claiming Social Security when you retire. This is fiction, total fiction. And here's the thing, guess what? Some of you might retire before age 62. You can't start claiming Social Security yet because you can't start claiming Social Security until you reach age 62. Some of you might retire in your 70s. Well, by that time, you're already going to be starting Social Security because it grows until age 70. 70 is the last point in which you can kind of hold off on taking it and have to start taking it. So if you're retiring in your 70s, guess what? Most likely you're already going to be having your Social Security come in. But I hear this statement probably most often from people that are between the ages of 62 and 70, thinking that, well, when you retire, you're going to have to start collecting your Social Security. If you retired at age 64, you probably should start your Social Security. If you retired at age 68, you should probably start your Social Security then. Folks, all of this is fiction. And here's the thing. I find a lot of times these decisions are being made to relieve pain. You've probably heard in different episodes before, but I kind of see that some people use Social Security as a pain reliever, just like we all try to, if we have a headache, right? Sometimes some of us try to get rid of our headache in different ways. I would potentially use Advil. My wife's going to drink a lot of water. And some people, they just don't do anything and they're lucky enough and the headache goes away. Well, a lot of times people use Social Security as a pain reliever as well, meaning they've just retired from their company. They no longer have the company paycheck coming in. And when they don't have income coming in, that can feel really scary and really painful. So what do? Use the pain reliever of Social Security. Is that always the best decision? It depends on your situation. For some people, it might be. For others, well, maybe not necessarily. Maybe what they should be doing instead is using their retirement investments, their IRAs, 401ks, maybe their brokerage accounts, and taking money out of those accounts first and letting their Social Security grow. Why would you want to do that? Well, every year that you delay taking your Social Security, you're getting an 8% bump on that amount for every year that you delay taking it. Now, do you have to take it on a specific birthday? No, you could take it at any point in time between the age 62 and age 70, any month. But just remember, every year that you delay taking it, you're getting a bump. Why is that bump important? Well, that bump is important because that is then your lifetime amount that you're going to get from Social Security. And on top of that, once you start taking, there's no more 8% bumps. The only bump that you're going to get is what they call as the cost of living adjustment that helps you keep up, well, kind of keep up with inflation throughout your retirement. So hopefully this helps you kind of rethink, do you need to take Social Security when you retire? No, not necessarily. What I'm saying is that, and again, I think this is fiction, because what you need to do is you need to put a plan together around your specific situation. Maybe if you're married, it makes sense for one of the spouses to delay their Social Security till age 70 and the other one to start taking their Social Security right away. That's thinking about survivor benefits and something that's really important there. So I would say, hey, put together a plan around your specific situation. Does it make more sense to take from your brokerage account, your investment accounts, your savings accounts, taking from those first and letting your Social Security grow? Because that Social Security is very similar to a lifetime pension, but a lifetime pension that gets a cost of living adjustment to it. So the higher amount that you can get, the longer that you live, the better off that you potentially are by waiting. So hopefully you understand that one's fiction. Again, for some people, it might make sense to take it when they retire. For others, it might not make total sense. You got to put together a plan around your situation. All right, let's go on to number 3. Number 3 is that you get to keep all of the Social Security benefits when one spouse passes away. This is fiction. And that's due to what they call survivor benefits. And see, this how survivor benefits work. And again, there's, let's just call it always some minor tweaks and exceptions to the rules here. But for the most part, you're in retirement. You and your spouse are similar in ages. How survivor benefits work is when one spouse passes away, you keep the higher of the two Social Securities. You don't keep both. You keep one of them and you keep the higher of the two. So let's just give an example here. Let's say we have Chris and Laura. Chris has a Social Security coming in of $3,000 a month. Laura has a Social Security coming in of $2,500 a month. So $3,000 plus $2,500, they've got $5,500 a month in Social Security income coming in. Well, let's say Chris, who has the higher Social Security, let's say he passes away. Guess what? Laura only gets to keep one of the two Social Securities, and she keeps the higher of the two. So in the remainder of her retirement, now instead of $5,500 a month coming in, she's only going to have $3,000 a month coming in. Hopefully, as I'm going through this example with you, you can also see how understanding survivor benefits becomes very important and something that you need to plan for if you're a couple listening to this, because Chris and Laura here in our example, they're $5,500 a month income. just now went down to $3,000 a month. If Laura wants to maintain the same lifestyle, guess what? Now she has to go and take more out from her retirement savings. Have they planned for that? Is that part of the plan? Will there be enough in the retirement savings, or does Laura need to reduce her lifestyle? That's all things that are important when it comes to the planning aspects around Social Security as well as your overall retirement. But back to the statement number 3 there, that you get to keep all of the Social Security benefits when one spouse passes away. That is fiction. Make sure you fully plan for and understand survivor benefits. All right, the 4th statement that I often hear, and is this one fact or fiction? You get penalized for working and taking Social Security, and you never get the penalty back. Wow, a lot going on in that statement. Let me read it again. You get penalized for working and taking Social Security and never get the penalty back. Well, what is this, fact or fiction? Guess what? This one is fact and fiction. And let me break it down for you, because there's really 2 parts, 2 statements within the one here. You get penalized for working and collecting Social Security. Well, I said fact, but this one just kind of, it depends. When could you potentially get a reduction? And we'll say, here's the word, penalty. You really don't get penalized. What happens is there's a reduction to your Social Security. Let me walk you through this here. They call it the earnings limit. So let's just say you are in the years before you reach your full retirement age. Well, in the years before you reach your full retirement age, if you make over the earnings limit, and the earnings limit is 22,000, again, 2023 here. I'm sorry, I said 2023 earlier. Wherever that was, guess what? We're in 2024. My brain must have been in last year. So we're in 2024. And let's just say the earnings limit, $22,320. If you make over that, there's a $1 deduction for every $2 that you make over that. What do I mean? Well, if you make $32,320, you're $10,000 over. Guess what? $1 reduction for every $2 over. So that's a $5,000 reduction then to your Social Security. Again, if you're collecting Social Security and working and making above the earnings limit in the years prior to your full retirement age. Now, the year of your full retirement age, the earnings limit goes up to $59,500, and it's a $1 reduction for every $3 that you earn over that amount. But here's the thing. Once you reach full retirement age, you've now hit full retirement age. Let's just say your full retirement age is age 67, and you reach your full retirement age in the month of July. Well, once you reach age 67 in the month of July, every dollar that you make from that point forward, all the money that you have coming in, all the Social Security that you have coming in, there is no more earnings limit. So from full retirement age forward, you can make as much as you want, collect as much Social Security as you want, and there is no reduction. Now, the second part to this statement, though, was that they never get the penalty back. And again, it's not a penalty, it's a reduction. And this is fiction. You see, you do actually get it back. What happens is that at your full retirement age, Social Security takes into account all of the reduced amounts that you've had prior to your full retirement age. And then there's a calculation that they go through. But in general, and let's just say very basic terms today to help you understand it, you basically get that money back, but you get it back over your lifetime. So you're not going to get it back right there in year one. You're going to get it back based on how long Social Security would calculate out that you would live. So they might divide that up by multiple years, and then you're going to get it in monthly chunks by just an increase to your overall Social Security benefit. So fiction to the fact that you never get it back. You do get the reduction back. It's just given to you over your lifetime after you hit full retirement age. All right, and the fifth and final statement that I hear a lot, so is this Social Security fact or Social Security fiction, is that it is better to collect your Social Security at age 70 versus age 62. Well, this can be fact or fiction, and it all depends. Now, let me say something that would be fact. You would get a higher amount at age 70 than at age 62. That's a fact. You would actually get more. You see, 62 is the earliest you can take Social Security, but it will be a reduced amount from your full retirement age. 70 is the latest that you could take Social Security, and it would be an increased amount from your full retirement age. Every year that you wait from full retirement age, you're getting an 8% increase on that Social Security amount. Now, is it better to take at age 70 versus age 62? It depends. That's not fact or fiction. It's just it depends. And here's the things that you want to consider when planning for your Social Security. First off, longevity and health. How long do you plan to live? The longer that you plan to live, usually the more that you'll be able to collect over your lifetime, the longer that you wait to collect and claim Social Security. Maybe you have some health issues going on. If so, and you plan to only maybe live in your 70s or late 70s, then the earlier in those time frames, it might make sense for you to claim and collect Social Security. Number two, how much are your expenses? So we talked at the beginning of the episode about the average expenses of retirees. Well, those aren't your expenses. How much are your expenses? How much do you need each and every month? Social Security is going to probably play a big factor into your overall lifestyle. How much will you have coming in to pay those expenses? Which leads us to the next thing then is how much have you saved? So how much do you have in your retirement savings, your retirement bucket of money? You see, between Social Security and your retirement savings, you have to optimize the connection between the two to help give you the most amount of income throughout your retirement. Number three, we talked about this one earlier, really also want to think about and factor in survivor benefits. So if you're a couple listening to this, maybe you delay one of them as long as you possibly can and take the other one early. It kind of gives you that benefit just in case somebody does pass away early, you started one early, but having that survivor benefit be larger if somebody does pass away for the survivor to help maintain their lifestyle. And then the fourth thing that you want to factor in is cost of living adjustments. So let's say if you take Social Security early versus if you delay and take Social Security up here, guess what? Wherever you start taking it, that's your fixed amount for life. The only bump that you're going to get on that is your cost of living adjustment. Would you rather have a cost of living adjustment on a number down here or a number up here? Of course, a number up here is going to give you a larger cost of living adjustment. But it depends. I realize Social Security is a very emotional thing of when people decide to claim it because it's something that you felt like you've paid into for a lifetime. And so I know you want to get the most back out of Social Security. There's no answer of when the perfect time is to claim it because none of us know how long we're going to live. And so there's a lot of things here, factors that I just went through that you really need to think about when it comes to your Social Security to then help you make the decision that you feel is best for your situation and for your life. And if you're going through that decision, like I mentioned earlier, we've got a guide that goes through a lot of Social Security claiming options and helps you understand the benefits of Social Security. You can get that at lifemoneyshow.com/Social Security. Again, lifemoneyshow.com/Social Security. Hey, I hope that you enjoyed today's show and episode. And if you want to hear more on Social Security, if you want to hear more on how to reduce the taxes on your IRAs and 401ks, you want to hear more on how to help maximize your future retirement story, well, hit subscribe on your favorite podcast player or on YouTube. That way you'll get notified as we're continuing to come out with new episodes and videos each and every week to help you on topics just like those. So don't forget, hit subscribe. That way you'll get notified. And I look forward to seeing you in the next video. Have a great day.
Insurance products are offered through the insurance business Sierens Financial Management, Inc. Sierens Financial Group, Inc. is an investment advisory practice that offers products and services through AE Wealth Management, LLC, AEWM, a registered investment advisor. AEWM does not offer insurance products. The insurance products offered by Sierens Financial Management, Inc. are not subject to investment advisor requirements. AEWM and Sierens Financial Group, Inc. are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims paying abilities of the issuing carrier. This podcast is intended for informational purposes only. It is not intended to be used as a sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual situation. Please remember that converting an employer plan account to a Roth IRA is a taxable event. Increased taxable income from the Roth IRA conversion may have several consequences, including, but not limited to, a need for additional tax withholding or estimated tax payments, the loss of certain tax deductions and credits, and higher taxes on Social Security benefits and higher Medicare premiums. Be sure to consult with a qualified tax advisor before making any decisions regarding your IRA. Sierens Financial Group, Inc. is not permitted to offer, and no statement made during the show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by Sierens Financial Group, Inc.
Scott Sierens Financial Group, and AE Wealth Management, LLC are not affiliated with the Wall Street Journal, Fidelity Investments, Charles Schwab, or the New York Times.